The stock I'm going to be talking about in today's video has been one of the best stocks in the country over the last 20-year period when it comes to shareholder returns. We're talking about 20 years ago, you would have earned about a penny a quarter on the dividend. Now you're earning nearly 60 cents. And the company has done such a good job at growing free cash flow per share. It's up around 1,800% over that 20-year time period. However, we're talking about a company that is in a relatively difficult operating environment. Not a lot of people understand these companies in depth. It's not surprising that this was one of the most heavily requested stocks in the comments for me to go over. And by the way, if you want me to go over a stock you're curious about, drop it in the comments. This is exactly how I decide to make these videos, but this is going to be another bull versus bear case on Canada's largest energy producer, that being Canadian Natural Resources. This is a company that is very shareholder friendly. It is one of the best operators in the business, but there is a lot of issues, maybe not necessarily in terms of Canadian Natural, but just in the industry in general. So I'm going to go over the bull case, the bear case, and my overall thoughts on Canadian Natural, but I got to tackle it in under 5 minutes. And this is going to be a very difficult one because this industry is complex. Canadian Natural is complex, but I'm going to try the best I can. And as always, everybody, before we get started, there's a ton of free resources in the description below, including my 3 top stocks for 2025. They're currently crushing it this year, up 21% versus the S&P 500's return of only around 2 or 3%. But let's get right into it. So what is Canadian Natural? Well, they are one of the lowest cost producers in the country. We're talking bitumen, we're talking natural gas. They are a dominant force in Canada. In fact, just globally, but the bulk of their production and the bulk of their operations are in North America. So in a nutshell, you're buying this company if you want exposure to the energy sector, primarily in that energy production. The first bull case would be that low cost of production, especially when we factor in the dividends paid. We can see here that their break-even point, which is the number it costs them to cover maintenance capital and dividends, remains in the low to mid US $40 per barrel range. So this is a company that is going to be able to not only fund its operations, but it's also going to be able to pay its dividends in the low $40 US barrel range. Now, this is one of the lowest costs, break-even costs among all Canadian producers. And if we go to crude oil prices today, we're seeing crude oil WTI at around $65 a barrel. So Canadian Natural has positioned itself to be a producer that can operate in the toughest environments. And we also seen that during 2020 when producers like Suncor were cutting the dividend. Canadian Natural came through and raised the dividend in one of the toughest oil environments we've been in. Now, another bull case is that free cash flow generation. If we look at a chart right now, we're seeing a free cash flow yield of 10%. So if you were to get a 10% free cash flow yield and that company were to return every single dollar of free cash flow back to you as a shareholder, you would break even in 10 years on your investment. Now, it's not that simple. Nothing works in a straight line, but a 10% free cash flow yield is very attractive. There's no doubt about it. Typically, I look to something above 7% as being pretty undervalued, but I'll get to more of that in the bear case as to why it's not as good as it seems, but it's still very strong. The company is very shareholder friendly. Previously, prior to the announcement of its Chevron acquisition, the board had decided to return 100% of free cash flow back to investors. And when they get that debt back to under $12 billion, they're going to allocate 100% of free cash flow back to shareholders. We can see debt of around $17.5 billion, and we can see EBITDA of $17.56 billion. This is effectively a 1x leverage ratio, which means Canadian Natural has the ability to very quickly pay off its debt. And I have little doubt that that $12 billion net debt position will be realized. And in turn, that company will be able to provide 100% of free cash flow returns back to shareholders. The final bull case here is that capital allocation back to shareholders. We're looking at 20-year dividend growth of 2,140%. They have a 25-26-year dividend growth streak, and they've grown free cash flow per share by 1,800%. So all of this dividend growth, all of these buybacks have been fueled by underlying free cash flow growth, which is definitely what you want to see. Now, the bear case is typically the fact that these energy producers are not necessarily the best long-term holds. That is because they are heavily cyclical to energy prices. As you can tell, whenever WTI tends to rise, Canadian Natural tends to rise, and whenever WTI falls, Canadian Natural tends to fall. If oil prices were to enter a prolonged bear market, it is likely that Canadian Natural's share price will remain flat to even potentially going downwards. Now, the other bear case here is valuation. Now, you can see the company trading at 9.8x free cash flow, which you would think on a surface level, this is a dirt cheap valuation, which I mean, in reality, it is. But the fact is, the market never really gives these companies all that high of a valuation. And we do have to come to the conclusion that the market will just not pay all that much for these energy producers. We're looking at a 5-year median average of 9.6x free cash flow, which means Canadian Natural is actually expensive compared to what it typically trades at. And ultimately, the only way we would get some sort of valuation expansion is if we see another bull market in terms of oil. And when we think about the overall environment with oil, it is dictated so much by outside sources that Canadian Natural really has no control over. I mean, OPEC could just decide to ramp up production one day, put some severe pressure, downside pressure on the price of oil, and ultimately Canadian Natural, despite doing everything right, will suffer. The bulk of their returns over the last while have come from a massive surge in energy popularity during the COVID-19 pandemic when, oil prices skyrocketed, things like that. So my overall thoughts, I do believe Canadian Natural is a high quality producer. It's one of the best in class in North America. However, you need to understand the underlying price of oil, the underlying price of natural gas will drive the returns of these companies. But I do believe Canadian Natural, especially with its 100% free cash flow return policy, which I do feel it will get back to eventually, is a strong option for a long-term hold. So everybody, that's it for the video. Hope you liked it. Head down below, like the video, subscribe to the channel, grab those free resources in the description. It takes just a few seconds. They're going to help you become a better investor. And as always, drop a comment down below. Let me know what stock you want me to go over next, and we'll see you next time for more great Canadian content.